Okay, Janet, right now, as we cover the entire presentation, again, it's very comprehensive slideshow presentation. Thank you and your husband to put together this very thorough slideshow presentation to talk about your market. You cover all the issues. So any investors, they analyze your market. There's no stones unturned. So you cover everything. So with that in mind, right now, let's share my screen and go over a few more slides. And let's go over the all important, what we call it, pro forma, the cash flow analysis, right? So again, these numbers are mere projections. They are not precise, just like any other aspects of real estate. This is just a projection. Things may change, but still, it's important for us to take a high level. The final combination of our investors researching due diligence, they have to crunch the numbers to see how all the numbers works on this fourplex and relative to the benchmark. What I mean by benchmark is in the investment arena, we always pair a particular pro forma relative to the benchmark on a comparison basis. And the benchmark is, but technically speaking, we use like rent to value ratio, capitalization rate, cash on cash return, debt coverage ratio, total ROI. But we're not going to go too much in depth about it. That's another video, another presentation between you and I in the future. But let's take a high level. Let's analyze the your product. Let's analyze your quad that you're presenting on this video. So with that in mind, so here's I took the liberty of crunching the numbers on my property tracker software, propertytracker.com. Anyway, so your property is 535K. So our investor put a minimal 25% down payment, which is a requirement per the Fannie Mae lending guidelines, 1 to 4 unit. We are able to do investor residential lending, which is the most favorable product to use, 30-year fixed rate mortgage. And that is an amazing mortgage product, needless to say. So at 25% down payment on this fourplex new construction, 535K here in South Texas, equals approximately, if you include all the other fees, around $148,000 down payment. All right. And then using this current, I know the mortgage interest rate our investor obtain, based on different variables. Some people want to buy down the points to get a lower interest rate, but I'm using the assumption of this mortgage interest rate for this fourplex purchase at an arbitrary 7.3%, which is without any kind of buy down. Of course, when an investor or contemplating buy this fourplex, they will choose a loan options which they feel comfortable. Some people want to buy down the points to get a lower rate, but this 7.3% is assuming they're using a straight out investor loan rate, maybe a little bit of buy down. I'm not sure, but yeah, again, 7.3%, which is coincide with your current mortgage rate environment. We all know how challenging that is, but you and I should agree, because you and I have been in this investment game for a very long time, that when an investor buy investment property, the interest rates are not that important, because the interest rate and the mortgage payment are only part of the cash flow analysis. It's a part of the debt obligation monthly, if you will. If everything, other metrics, numerical metrics make sense, as in this case, then it's a good purchase, because I use this term, date the mortgage interest rate, but marry the multi-unit. You like that?
I like that.
Because as an investor, we have the ability to pivot. We have the ability to negotiate our investment property over time, and everything is negotiable. Everything can be changed. Investor, we're different. Primary home buyers are very limited, right, in their strategy. Being an investor and being a primary home buyer are extremely different. It's the difference between night and day. Investors look at the numbers. They look at the cash flow, and so forth and so on, not just the mortgage rate. So let's go through the numbers, right? And the gross rent, I put a projection of gross rate of $5,400. So per door is like $1,325, $1,350, based on the potentially increasing rental rates that you and I discussed. So all 4 doors, total $5,400 gross monthly rent, minus a little bit of vacancy factor here, which is right here, 4% vacancy factor, real estate appreciation projection in your market, let's say around 5%, and the property management fee is 8%. And so therefore your gross rent 5,400 and your property taxes, which is $750 per month, which is $9,000 per year. These are less than 2% property tax rate. So that's not too bad in terms of Texas, relatively speaking. So this is a very achievable. Is nothing. I don't see any kind of red flag. Property tax rate is a little bit higher in Texas than in other markets, but you offset that with you get no state income taxes if you are a resident of Texas. So that's that's an offsetting scenario. Plus, the property tax here is part of the monthly expenses anyway. It's part of the debt obligations that any investor will look into when they own a rental property. So insurance, pretty reasonable, $183 per month. Property management fee, $415. So then you have the total debt obligations down here. Then based on 7.3% mortgage, 30-year fixed rate interest, the monthly mortgage is, I can't even see, $2,000 something dollars. At the end of the day, $5,400 gross monthly rent minus the all your debt obligations, including the mortgage payment, equals monthly net cash flow was a little bit more than $1,000. So we're talking per door, per unit, out of the 4 unit, you get a monthly net cash flow per unit around $250. Multiplied by 4 doors, 4 units, equals monthly net cash flow at a little bit more than $1,000. As we stated, in the next few years, we don't know the future of the mortgage interest rate. No one have a crystal ball, but most experts agree that the interest rate will come down. We just don't know when. So again, this 7.3 mortgage interest rate, you take the interest, but you marry the multi-unit, so you can have the potential to cash out refinance. Once the mortgage rate come down to 6.5% to 6% for investor, then if you cash out refinance based on a future 6% interest rate from the 7.3%, you and I will probably agree that this monthly cash flow, which is a starting point right now of $1,000, could be $1,200, $1,300, or even slightly more, especially when you have a projection of a rental rate increase around 5%. So do you agree so far?
Yes.
Yeah. And finally, up in the upper right-hand corner, I know we're not going to spend enough time to go over the numerical formulas, but any savvy real estate investors don't understand what I'm talking about. But newbie investors, they may need time to digest what we can talk about. But up in the upper right-hand corner is 1% rent to value ratio. The 1% rule, which have been around for a very long time. In the past years, early in a decade, the 1% rule applies to investment property. The 1% rule means if you buy a property for $100,000, for example, a rental property, if you multiply by 1%, that means your monthly gross rent is $1,000. This kind of a metric is very positive. It tells someone that the positive cash flow is very high. But having said that, based on the last few years of skyrocketing housing prices and the elevated mortgage rate, the 1% rule usually are out the window. There's unrealistic expectations. Now, having said that, Janet, because as a real estate investor, as a real estate coach that I am, I take my investors to buy in many different markets in the U.S. for the past 20 years, turnkey, out-of-state properties. And the 1% rule has applied for many years until recently. The 1% rule still makes sense in the Midwest, right? When you buy investment property in the Midwest, the prices are very cheap. They're much older. It's a cash flow market. And the 1% rule still applies today. You can still buy in the Midwest a much older property in a middle class or lower class neighborhood in the Midwest, which covers a lot of areas, right? So you could buy a $100,000 property with 1% rule, you get $1,000 monthly rent. Bang, just like that. It's a very attractive cash flow. It's on a cash flow market. But to see a 1% rule apply to your market in Texas, in a new construction, on a fourplex for that matter, is extremely rare. And I have done a lot of research, not just recently, but over time on all the markets in the US. You're not going to find a new construction, especially a fourplex, in a fast-moving market, in the appreciation and cash flow market, or hybrid market, such as in Texas, where you get the 1% rule on your product. 535K, fourplex new construction at 1%, right? Which is 5,400 in your case. That is absolutely not happening anywhere in the country as of right now. Let me give you another comparison, Janet. Okay, a fourplex up the road 3 hours to the north of your market in San Antonio, for example, a fourplex at 4,000 square foot. In fact, let's share the screen. Let's talk like this. A fourplex new construction in 3 hours to the north in San Antonio at 4,000 square foot it'll cost you anywhere from 900,000 to $1 million, and the rent per door is only like 1,500, 1,600.
I know.
So if you do an apple to apple comparison, the cap rate here down here in South Texas, here in the McAllen Metro, Hidalgo County, in your market, it is mind-boggling. And by the way, in other part of the country, any kind of very good new construction fourplexes have been built. It's hard to build for any builder to build a fourplex new construction, let alone the price that we're getting here, 535K. A fourplex new built at 4,000 square foot in Los Angeles will cost you like $2 million. And the rent is only $10,000 per month, which is give you a cap rate of 5%. If you buy if you can find a new construction fourplex, let's say in Florida, which I'm promoting in Florida too, a fourplex similar square footage, your product is probably around 800,000. And the rent is, they're not going to meet the 1% rule. And the rent is 800,000. Their rent is probably total of 6,500 on all four doors. So their cap rate is a lot lower on new construction, comparably speaking, with your product. And of course, you can't compare a Midwest fourplex because you're not going to find new construction fourplex in the Midwest. You can only find, Midwest is not an apple-to-apple comparison because it's a casual market and you're not going to get the appreciation potentially you can get down here in Texas. So I'm not even going to compare. Yeah, you can find for 1% row in the Midwest on a much older property, C-class neighborhood, whatever, which is pure. A lot of people still does that because the prices are so cheap in that area. But we're talking robust market in your market, which your market is similar to the Sun Belt, right? Sun Belt market, which is the warm weather markets, fastest growing markets in the country, Texas and Florida and a few other states. If you compare to any new construction fourplex, 4,000 square foot into Utah or Phoenix or Las Vegas, their prices are $1 million and their rent is low. The cap rate, like 4% cap rate in those markets. So really no comparison. And you and I mentioned why when I venture into your market in South Texas, how come the new construction is only cost $535,000? Is it too good to be true? And rent is $1,250, $1,350. It meets the 1% rule in a Texas market, fast-growing markets such as your market. And your answer to me was that the cost of land is cheaper, at least right now here in South Texas. Therefore, the builder are able to take advantage of the low development costs, buying the raw land to build the fourplexes for investors such as us. So right now, the timing could not be better. Who's to say that the land cost is not going to increase for the foreseeable future in your market? You have to believe it's going to increase.
It's happening already. Yeah.
Yeah, exactly.
And it's going up. Yeah.
I have no doubt this is the early phase of growth in your market. So we already discussed that. Let's get back to the pro forma. All right. Yeah, the pro forma at the upper hand corner. So just to summarize this amazing pro forma cash flow analysis, upper right hand corner, as you can see, the rent to value ratio which is 1%, which is to me as an investor for a long time. And I have taken my investors for the past 20 years to buy hundreds and hundreds of properties out of state. The rent to value ratios are 1%. This is mind-boggling, such a value add product in your particular market. And the capitalization rate, as you can see in the upper right-hand corners, 8.4% cap rate. This is mind-boggling. A usual cap rate on a fourplex is by anywhere in the country is only by 4% cap rate, half as low. And cash on cash return on your fourplex product is cash on cash return. This is also very good. And the total return on investment is 29%, which is double, triple digit just the first year. All right. So let's continue on. So this is pretty much the end of the pro forma. But wait, there's more. Let's dive deeper. We just went over just the first year projection, Janet. The first year projection is very attractive, even with the low, higher than usual 7.3% projected mortgage interest rate for the investor to finance his property. There's more. But you look at the gross annual rent, gross rate before deduction, first year, 5,400 multiplied by 12 months. Yes, 64,000. But we have to project 5% rental rate increase. Why? Because rental rate increase with the cost of living. The rental rate increase based on inflation, or inflation is at least 5 to 10% right now as we speak, right? So the gross rent, you can see from year 1 to year 10, you see a systematic gross rent increases. So your cash flow and your passive income from the multiple streams of income from 4 doors, from 4 tenants, you have 4 tenants, you can potentially increase the rent over time. So your cash flow can increase over time, year to year, hopefully. No one can predict the future. And then your passive income will increase accordingly. But, at the end of the day, we all want passive income to achieve our retirement. So if you project long-term investment, this is the case, we're promoting buy and hold long-term, you and I, right? This is our investment methodology. So as you can see, the gross rent will increase. And then you look at the debt obligations, they will increase a little bit. The expenses on the management of the property, nothing else. Then look at something else. Look at the second page, the second slide. Then, then here's the minus the vacancy. Here's the net operating income. Because you're doing an amazing 30-year fixed rate mortgage, which I call it the 8th wonder of the world, the 30-year fixed rate. The 30-year fixed rate mortgage, no other country in the world have this type of amazing loan product, right? It's the capstone, it's a blueprint for financial freedom, leveraging your debt through an amazing 30-year fixed rate mortgage will stay. Your mortgage will not increase in light of everything rising in cost. Inflation will destroy your wealth, but not rental property, not real estate. Your mortgage, inflation is your friend. Is a inflation. Another definition for me on a mortgage for an investment property is a inflation-induced debt destruction. This is a term came up by another person, not me. His name is Jason Hartman, in case you want to know. He called it the 30-year fixed rate mortgage for investment property is an inflation-induced debt destruction. So when people out there hear my word from this video, go ahead and come up to your own conclusion of what I mean by that. I'm not going to go into that. Cash flow, as I indicated earlier, will continue to increase, hopefully, over time based on historical comparisons. Then each time the renter will pay down your mortgage, you get some kind of benefit in terms of principal reduction, yes, be it ever so slightly on an annual basis. And then, of course, based on the projected 5% appreciation rate and your property, your investment property will compound. The magic of compound interest is another 8th wonder of the world. So based on 5% appreciation, you will see the systematic appreciation associated with earning this rental property. And then, of course, cap rate will continue to increase over time. And then here's a real nice thing. Based on a mere 5% appreciation, which on a year to year, which is based on historical past performances, long term on a real estate. You see the market value, we buying at a benchmark at 535K. A year later at 5% appreciation. At the end of the first year is 561. So based on 5% appreciation, yes, you can see the market value of this property continue to increase over time. I know there's some dips every now and then. There may be some correction that will occur from time to time over a long-term perspective. We're not going to get into that. But another great thing about it is your 25% down payment is your leverage to buy this fourplex. But the beauty of owning a rental property, you and I, Janet, we've been in this game for a very long time. Investor, they're going to outsource someone by the name of tenant. In this case, 4 tenants, they're going to pay your mortgage for you. Not only the 4 tenants going to pay your mortgage for you, going to pay down your mortgage over time, but your 4 tenants going to pay your monthly property taxes. Your 4 tenants in this 4-plex going to pay down your property monthly insurance. Your tenants going to pay down your property management fee and the vacancies and upkeeps and maintenance. At the end of the day, you're still going to get monthly positive cash flow. So let your renter make you rich. All right, multiple streams of income from 4 doors. Janet, this is getting good, isn't it? This is a double benefit. So therefore, over time, your market value of your 4-plex increase by these numbers accordingly. Compound growth of equity appreciation based on 5%, could be more, could be less in any given year. We don't know the future. But anyway, but your loan balance gets decreased over time, right? It's the amortization of your 30-year fixed rate mortgage. So your loan balance going to get decreased time, and your appreciation of your property increase from a historical point of view. Then you have market value from year over year minus decreasing loan balance year over year equals, that means your equity will continue to rise. You see the rising of equity from 164K at the end of the first year to systematically more at the end of the 5th year. The equity can rise more than $300,000 of pure equity. Value minus loan balance equals net equity. Then this LTV, loan to value ratio, loan underwriting is such that once you meet the 70% LTV, loan to value ratio, you can qualify to refinance your loan, to tap into the equity out to do what? Buy more rental property. So therefore, now this is one of the exit strategies that investors can do if they want to. There are multiple exit strategies available for investor over time. But this kind of software allow an investor for the next 2nd, 3rd, 4th, 5th year based on their investment goals and objectives to determine whether they want to catch up refinance. They don't have to, they don't want to. So every investor have the ability to make decisions that fit their goals and objectives. But given these metrics, they could refinance at any time in the next 10 years, right? When you do a catch up refinance, guess what? It's tax-free. When you borrow against the equity of your investment property, it's a tax-free event. So real estate investing gives you multiple layers of benefits, and tax benefits is one of them. Of course, you and I are not a licensed tax advisor. Consult your own tax advisor to go over your unique tax situation. But this is just an educational video, by the way. So this is the potential cash out refinance. Look at this. You are able to clearly see if you were to cash out refinance, how much money you can get out of it. If you want to cash out refinance at the end of the 4th year, you have 71 grand. Okay, you have 71 grand to do. So can you buy another single family home rental or duplex at the year 4th? Of course you can. So that's how you scale your real estate portfolio. If you want to scale your portfolio, you do a potential cash out refinance. Now, one going to ask you and I, for example, Seewing, if you and Janet, if you cash out refinance, your mortgage payment is going to be higher because you have to pay a higher loan amount. Yes, that's true. I'm not going to get into the calculation of it, but yes, once you cash out refinance, for example, this $71,000, for example, your mortgage payment will be higher than originally what you pay on your monthly mortgage payment. But by the 4th year, your rental rates have already increased at the tune of 5%, whatever. So you have more cash flow, right? And also you can increase your rent from year to year, theoretically speaking. So you still have enough positive cash flow available from your property to absorb the higher mortgage payment as a result of the cash out refinance to leverage into buying additional rental property at some point in time in the future. Am I right or wrong, Janet?
Correct.
Okay. All right.
Absolutely.
As we conclude this, of course, just to review your beautiful, high quality construction of your quad fourplex in McAllen Metro, South Texas. I'll quickly go over this because you already gone over this on our earlier slideshow. I'll do this real quickly. Then we'll come back to our main screen momentarily. It's a beautiful property.